Exactly. We are getting into a really useful, and I think surprisingly intuitive, technical indicator today. It's called the Chaikin Money Flow, CMF for short.
CMF, right.
Yeah, and our deep dive is all about understanding how money is actually flowing, into or out of a stock or security.
So not just the price moving up or down.
Precisely. It's more about the conviction behind those price moves. It helps you spot potentially strong trends and check if they've got real strength behind them.
Okay, got it. So our mission today for you listening is to really demystify this CMF thing. We want to look at where it came from, how it's calculated, but in a way that actually makes sense listening to it.
Yeah, not just reading out formulas.
Definitely not. And then how traders actually use the signals, what they look for, and importantly, what are the catches? What are its limitations?
Critical point.
We've looked at a bunch of different sources, financial guides, charting platform info, even some expert trading webcasts. So let's just dive in, shall we?
Let's do it.
All right, so the Chaikin Money Flow, it starts with the creator, right? Mark Chaikin.
That's the man. A real legend in financial analysis developed this back in the 1980s.
The 80s, wow.
Yeah, he spent decades on Wall Street, eventually started his own analytics company. He built CMF as this, elegant tool to gauge buying pressure.
Which traders call accumulation.
Accumulation, yes, versus the selling pressure, which is distribution, over a set time period for whatever security you're looking at.
And it came from a core belief he had about the market.
It really did. What's so interesting about CMF is how it visualizes things. Think of it like a volume-weighted oscillator.
Okay, volume-weighted. What does that mean in practice?
It means it doesn't just track price. It layers in trading volume to show this tug of war between buyers and sellers visually. It usually moves between -1 and +1.
Right.
Though sometimes you might see platforms show it as -100 to +100. Same idea, just scaled differently.
Okay, so that range, -1 to +1, basically tells you if money's coming in or going out.
That's the gist of it. It helps you see the flow pretty quickly.
And Chaikin's big idea, his conviction,
Yeah.
what was that exactly?
His core belief was this. If a stock's price consistently closed near the top of its daily trading range.
Near the high for the day.
Exactly. And especially if that happened on high trading volume. Chaikin believed that wasn't random. That signaled real buying pressure, committed money flowing in.
Makes sense.
And the opposite was also true. If it kept closing near the lows, again on high volume, that pointed to serious selling pressure, distribution.
So the CMF was built to basically quantify that intuition, to put a number on it and graph it.
You got it. To graphically show that underlying strength or weakness behind the price moves, it gives you a deeper look into what the market's really doing, like seeing how people are voting with their wallets.
Okay, interesting. So how is it calculated? You mentioned most platforms do it automatically.
You do, yeah. Click a button and it appears on your chart.
Mm-hmm.
But really understanding the mechanics, the 3 steps Chaikin designed, is super helpful.
Why is that? If the computer does it?
Well, it's not about doing the math yourself. It's about appreciating what the indicator is actually measuring, why it moves the way it does. It helps you interpret it better and spot when maybe something looks a bit off.
Okay, like knowing how your car engine works, roughly, helps you know if that sound is normal.
Exactly, that kind of thing. And we'll use the typical 21-day period for our example because that's pretty standard for CMF.
All right, 21 days. Let's pull back the curtain then, the how it's made segment. 3 steps.
3 key steps.
First up is something called the money flow multiplier, MFM.
MFM.
Now, let's skip the heavy formula reading. What's the logic here?
The logic is simple. It just figures out where the stock closed within its high-low range for that specific day.
So like top half, bottom half, middle?
Precisely. If it closed in the upper half of the range for the day, the multiplier is positive. That suggests buying pressure won out by the end. If it closed in the lower half, the multiplier is negative. Sellers had the upper hand.
And it's intuitive too, right? Close right at the high.
That gives you a perfect +1 for the multiplier.
And close right at the low.
A perfect -1. Anywhere in between is just a fraction, positive or negative. It's the first step in sizing up that daily battle.
Okay, so that tells us about the close quality. Step 1, what's next?
Step 2 is money flow volume, MFV. This brings in that critical element Chaikin cared so much about, volume.
Ah, the volume piece.
Yes. You just take that money flow multiplier we just figured out, the +1 or -1 or fraction, and multiply it by the total trading volume for that same day.
Okay, so multiplier times volume. What does that achieve?
It means days with more trading volume have a much bigger impact on the final CMF reading. A strong close near the high is significant, but a strong close near the high on massive volume. That sends a much more powerful signal about money flowing in.
Right, it weights the signal by conviction. High volume, more conviction.
Exactly. Volume confirms the price action. It's the market showing its commitment.
Got it. MFM, then MFE. What's the final step?
The final step is the Chaikin Money Flow, CMF itself. This is where we pull it all together over our chosen period, like that standard 21 days.
Okay, so we average it out somehow.
Sort of. You basically sum up all those daily money so volume values over the 21 days. Then you divide that total by the sum of all the trading volume over those same 21 days.
Ah, okay. So it's the total net money flow volume divided by the total volume.
You got it. It shows the net money flow relative to the overall trading activity during that period. The result is that single CMF value, swinging between -1 and +1.
Giving us that final gauge of whether buyers or sellers were really in charge over those 21 days.
That's the whole point. It boils down to asking, over the last few weeks, did more money effectively flow in or out of this stock? And crucially, how much volume, how much conviction was behind those flows?
So a high positive CMF means real buying, real accumulation, backed by solid volume.
Often, yes. It can be a strong sign confirming an uptrend or sometimes even preceding one.
Okay, that makes sense. So now we know how it's built. How do we actually, use it? Read the story it tells.
The most basic interpretation starts with the zero line. That's your baseline.
Right. Above zero, below zero.
Exactly. When CMF is consistently above zero and maybe even climbing towards +1.
That means buying pressure is dominant.
Correct. It suggests accumulation is happening, money is flowing in, sentiment is generally bullish. It backs up the idea that a price rise has real capital behind it.
And the opposite, below zero.
If it's consistently below zero, heading towards Medical 1, that points to selling pressure being higher. Distribution, money flowing out. That usually aligns with bearish sentiment and can confirm a downtrend.
What if it's just hovering around zero?
Then buying and selling pressure are pretty much in balance. No clear winner. Often happens when the price is just moving sideways in a range. CMF isn't very decisive then, because the market itself isn't decisive.
Okay, that's the basic sentiment read. But traders use it for more specific signals, right?
Yeah, absolutely. The practical uses are where it gets really powerful. One big one is trend confirmation.
How does that work?
Let's say you see a stock price climbing. If the CMF is also solidly above zero, that gives you extra confidence that this uptrend is, well, legit. It's backed by actual buying.
Not just noise.
Right. And likewise, a negative CMF below zero helps confirm a downtrend strength. And if you see the CMF value itself getting stronger, like moving further away from zero, that suggests the momentum of that money flow is picking up.
Interesting. What about changes, like crossing that zero line?
Yes, zero line crosses can be important signals, potentially early signs of a trend reversal. A bullish cross is when CMF moves up from below zero and breaks convincingly above it. It suggests sellers might be losing control and buyers are taking over. Could signal a new uptrend starting.
And a bearish cross.
The reverse. CMF falls from above zero to below it. Suggests buying pressure is fading, distribution might be starting, could be a warning of a potential downtrend.
But you need to be careful with those crosses, I imagine.
Very careful. You can get brief pops above or below zero that don't last. They call them whipsaws, false signals.
Right. Frustrating.
Definitely. So many traders use a kind of buffer zone. They might wait for CMF to get beyond, say, plus 0.05 or below -0.05 before they really trust the signal, just to filter out some of that noise.
That makes sense. Give it a little room to prove itself.
Exactly. But maybe one of the most powerful uses is spotting divergence.
Ah, divergence. I hear traders talk about that a lot. What is it in this context?
Divergence is when the price of the stock is doing one thing, but the CMF indicator is doing something different. They're telling conflicting stories.
Like what?
Okay, take bearish divergence. The stock price pushes up and makes a new high. Looks strong, right? You'd think bullish. But if you look at the CMF indicator, it fails to make a new high. Maybe it makes a lower high, or it's flat, or even declining.
So price is up, but the money flow isn't confirming that strength.
Precisely. It's a red flag. It suggests that the buying pressure, the actual money flow fueling that price rise, is weakening. The uptrend might be running out of gas, even though the price just hit a new peak.
Okay, so that's a warning sign for a potential reversal down. What about the other way?
That's bullish divergence. The stock price falls to a new low, looks bearish, maybe like it's going to keep falling.
Right.
But the CMF indicator doesn't make a new low. Maybe it makes a higher low, or it's starting to tick upwards already.
So price is down, but selling pressure is actually easing up, according to CMF.
You got it. It hints that even though the price is dropping, the selling isn't as strong as it was. Money might even be subtly starting to flow back in. This can often happen before the price actually turns around and starts heading up.
That's really useful. I remember seeing an example, I think it was from a Schwab webcast, where CMF gave a bullish signal on a day the overall market was really down. And seeing that CMF signal, suggesting buying pressure underneath the surface even on a bad day, could give a trader confidence. Maybe they take a long position.
Right, using the CMF as one piece of evidence.
Yeah, and then they'd manage the trade, maybe set targets based on previous price moves, put a stop loss below recent support, using the indicator within a plan.
That's the key.
Oh.
Using it as part of a plan, which brings us to a really critical point from pretty much all the sources we looked at.
Which is?
Chaikin Money Flow should absolutely not be used as a standalone indicator, ever.
Okay, emphasize not standalone. Why is that so crucial?
Because no single indicator can capture everything happening in the market. CMF tells you about money flow relative to price and volume, but it doesn't tell you about overall market trends, support resistance levels, momentum, in the same way other tools do. Relying only on CMF is risky.
So it needs friends. It works best with other indicators.
Exactly. It's best used in conjunction with other tools. Think about building confluences.
Confluences.
Yeah, that's when you get multiple different indicators all pointing the same way. Maybe CMF is above zero, showing accumulation, and the MCD indicator crosses bullishly, and the price bounces off a key moving average.
Ah, so multiple signals agreeing.
Right. That gives you much stronger confirmation, much more confidence in a potential trade signal than just looking at CMF alone.
That makes a lot of sense. Okay, so don't use it alone. What other nuances or limitations should we be aware of?
Well, first, it's generally seen as a lagging indicator.
Lagging meaning it's based on past data.
Yes. It reflects what has happened with price and volume, so its signals might come a bit after the absolute turning point in price.
Yeah.
You might miss the very bottom or very top.
But the trade-off is you get more confirmation, maybe avoid jumping in too early.
That's the idea. Also, CMF tends to work better, be more reliable in trending markets with a clear up or down direction.
And less reliable when things are choppy or sideways.
Correct. In range-bound markets, CMF often just oscillates around that zero line without giving clear, strong signals.
Yeah.
Because the market itself isn't going anywhere decisively.
Okay. Anything else? Any quirks?
There's one really interesting calculation quirk. Remember the money flow multiplier? Step 1?
Yeah, where the close falls within the day's range.
Right. Well, the quirk is that it only looks at that day's range. It doesn't really account for big price gaps between days or big changes in the size of the daily range itself.
How could that cause an issue?
Think about this. A stock could gap down massively at the open, trading way lower than yesterday.
Okay, definitely bearish action overall.
But let's say within that new lower daily range, it manages to rally a bit and closes above the midpoint of that specific day's high-low range.
Ah, so even though the stock is down huge overall, the MFM for that day would be positive.
Exactly.
Yeah.
Because it closed in the upper half of its own daily range. This can cause the CMF reading to sometimes seem disconnected from the obvious price action. It might tick up slightly, even on a big down day, just because of where the close landed within that day's bar.
Wow, that's a subtle but really important detail. It shows the calculation isn't capturing the full picture of the price drop in that specific scenario.
It's a known limitation. It highlights why you can't just blindly follow the indicator. You need to understand how it's calculated and look at the price chart too.
Good point. Now, since we're talking Chaikin, people might know about the Chaikin oscillator too. Is that related? How does it differ from CMF?
Great question. Yes, definitely related. It's part of the same family, both derived by Mark Chaikin from the concept of the accumulation distribution line.
Okay, so what's the key difference?
The focus. CMF, as we've hammered home, is about the level of accumulation or distribution pressure averaged over time. Like, is money generally flowing in or out over the last 21 days?
Right, the flow itself.
The Chaikin oscillator, on the other hand, measures the momentum of that accumulation distribution. It looks at the rate of change.
How does it do that?
It actually calculates the difference between a short-term moving average, usually 3-day, and a longer-term moving average, usually 10-day, of the accumulation distribution line. And the concepts behind CMF feed into that AD line.
So CMF shows the flow's direction and general strength, while the oscillator shows how fast that flow is accelerating or decelerating.
That's a great way to put it. A trader might use CMF to confirm an established trend, but use the oscillator to look for earlier signs of momentum shifts or potential divergences that might signal a turn is coming sooner.
So they offer slightly different perspectives on the same underlying idea. Complementary.
Very much so. Different tools from the same toolbox designed for slightly different jobs.
Excellent clarification. Okay, so let's try and wrap this up. We've taken a deep dive into the Chaikin Money Flow. We looked at its origins with Mark Chaikin. We really broke down how it's calculated step by step.
Hopefully in a way that made sense.
I think so. And we talked about how traders read at the zero line, crosses, divergences, and maybe most importantly, its limitations. Remember, it's powerful for seeing buying or selling pressure, but it needs to be part of a bigger strategy, not a standalone magic wand.
Couldn't say it better myself. And maybe a final thought for you, the listener, to mull over. Thinking about that calculation quirk, we discuss how CMF can sometimes disconnect from price because of gaps.
Yeah.
How does that challenge our assumptions about what money flow really means in every single context? And maybe more broadly, how does understanding quirks like that push us all to be more critical users of any technical indicator?
To always look a bit deeper.
That's a really provocative question.
Yeah.
Don't just take the indicator at face value, but understand its potential blind spots. Great takeaway. We definitely encourage you to explore this more. Maybe pull up CMF on a chart in a practice account. See how it behaves.
Play around with it. See how it looks next to a MACD or RSI on stocks you follow. Absolutely. Discovering how these tools work and work together is a continuous learning process, and hopefully today's deep dive helped you on that journey.